So chapter 1 is about introduction to financial system in Malaysia. So let us look what are the learning outcome for this topic. So at the end of this chapter, it is expected from the student to be able to understand the structure of Malaysian financial system, able to list out the objective of each of banking system that we have in Malaysia, and list out the financial instrument that are available in the financial market. So these are the expectation from student, what they will get at the end of the chapter. All right, so the overview of financial system. So the overview of financial system, it is about lender and saver, or it is also known as borrower and spender. So who are the lender? Lender is a person who have surplus in fund. They will save their money in bank. All right. So who are borrower? Borrower is a person who have shortage in fund, where they need money to buy to spend, to do the spending. So basically how where they can get the money, where they can get the fund is through financial intermediaries. So in financial intermediaries, there are systems where the lender and the borrower can interact together. Okay, so borrower, when they need money, they will go to financial intermediaries and ask for fund. While for lender, because they have more money, they will put their money in financial intermediaries, because they trust the financial intermediaries to keep their money. All right. So these financial intermediaries, with the money, with the fund that they have, they utilize the money to earn more money. All right. So that is the overview of financial system. All right. So as for you to have a clear in mind, what is financial system? Financial system, they will perform the essential economic function to channel fund from the units of surplus fund to unit who have shortage in fund. Okay, so the person who have shortage in fund, we call them as borrower, while the person who have surplus in fund, we call them as lender. So who are the lender? Is the saver, and the borrower are the person who spend the money. All right, the channeling of the funds from saver to spenders is very important for two reasons. So the first one is the lender saver, with the access of the available funds, do not frequently have a profitable investment opportunities, while borrower spenders have an investment opportunities but lack of fund. So that is the first reason. So the spender, they want to spend the money because they believe they know how to generate profits, but they do not have enough money. They do not have enough capital to generate the profits. So what they do, they will borrow money. All right. So saver, they lend the money to the borrower because they lack of skill to generate money, but they have money. So what they do, they spend the money, they save the money to financial intermediaries, and let the financial intermediaries use or utilize the fund and give them to a person who are skillful to generate profit. So in return, the spender, the borrower, will pay back the borrowed amount together with profit rates, based on the profit rates, and it is given to the lenders, because this money, this fund is belongs to them. So that is the first reason. The second reason, even for purpose other than investment opportunities in business, the borrowers, which is the spenders, may want to invest in excess of their current income or to adjust their composition of their wealth, or we call it as a reconciliation of the preference for current versus future consumptions. So what it means that today's value, the value of money today is better compared to tomorrow's value. It means that the power, the purchasing power of money today is higher compared to tomorrow's value. Okay, so that's why people put it in places where can give profitable rates, is because of they want to increase the value of money. All right, so in short, the flow of the financial system, it is explained using this flow of funds. So there are direct market and there are indirect market. Financial system, it consists of borrowers and lenders. So this borrowers and lenders, how they interacted together is through direct interaction. They are also interacted through indirect interactions. So lenders and borrowers, they will directly interacted with each other if both of them meet in financial markets. So they will do the transaction by themselves. So it is direct transaction. However, if they go to financial intermediaries, actually lender and borrower, they are interacted together, but they not meet each other. So lenders go to financial intermediaries because they have funds, they have surplus in funds, they have more money, so they do saving in financial intermediaries. All right, so borrowers, they are shortage in fund. They need more money to generate profit. They need more money to use as a capital for a business. So what they do, they will go to financial intermediaries and ask for funds. So financial intermediaries, they have money which has been given by all the lenders, by all the savers. So they not just keep the money in the bank. They not just keep the money in the store, but what they do, they will give out as loan. So who will take the loan? The borrowers. All right. So in return, the borrowers will pay back the money together with the profit rates, and this profit rate belongs to the lenders because the money belongs to lenders, and lenders also get the return. Okay, so lenders will give cash. So the flow is lenders give fund to the borrowers, while borrowers will give back to the lenders the securities. So this is how the flow of funds in the financial systems. All right. So in direct market, lenders give the borrower money, which is the cash, and in return, the borrower will give the lenders securities. Okay, so it depends on the contract, how much is the return that will be given to the lender. So that is direct market, direct interaction between lenders and borrowers. For indirect, lenders and borrower will meet together in the financial intermediaries. So they are not meet face to face, or they not interacted directly, but they interacted, both of lenders and borrowers, they interacted with financial intermediaries. So when the lenders save their money, which is they save their cash in bank, so bank will give them how much is the deposits of the lenders. So then, yes?
Yang lenders give money to financial intermediaries tu kan? Is it they give through savings account or through bursa or something like that?
It can be saving account. It also can be investment account.
Oh, okay.
Okay. Am I?
So the direct financial market, just lenders give full loan borrowers with interest like that and better.
Something like that. It can be bond, it can be shares, it can be any other financial securities. Financial instruments. It can be any lah. Securities means that what are the securities for the securities means that the financial instruments. What are the financial instruments that they trading? It can be warrants, it can be derivatives, it can be many things. So depending on what financial markets that they are entering. So that's how the flow of funds in the financial systems. Okay. Any other question on the flow of funds in financial system?
No, madam.
Okay. All right. So let us move. So this is just an explanation in the direct finance, borrowers, spenders, borrow fund directly from lenders in the financial market by selling them securities. And then, so lenders will buy the securities in the financial market. Borrowers sell their financial securities, and then the lenders will buy the financial securities. So that is indirect. That is direct finance. Indirect finance, a financial intermediary stand between lender saver and the borrower spender. The intermediary help to transfer fund from one to another. So actually, the financial intermediary will decide how much it is appropriate to give to the borrower for each of the borrower. Instead of we interacted directly, we have no proper contract. So it's better that financial intermediaries who decide how much it is appropriate, how much is the appropriate amount that can give to the borrower. Okay, because in financial intermediary, they have the ability to see the ability and the capability, the capabilities and the capacity of the borrower. So that's why we have secrets, we have credit ratings, lots of that. Before we want to take up any loans or borrowings, there is lots of credit ratings that we have to qualify in order for us to come up with any borrowings. So that's how money, the flow of money among people, governments, as well as individuals. Individuals, governments, and also corporations. So these three parties, they can be individuals, they can be government, they can be corporations. The corporation also can be the one who has surplus in fund. Corporation also can be the one who need to borrow money. Same goes to individuals and governments. Individuals, contoh Miss Aisyah adalah orang yang menyimpan duit, dalam masa yang sama Miss Aisyah juga adalah orang yang perlu pinjaman untuk beli rumah. Itu contoh dia. So it means that both parties can come from the same background, same people. All right. So the structure of Malaysian financial system. So the structure, it consists of these three things. Okay, in the financial markets, what are the securities that have been traded, and what is financial intermediaries that are available in Malaysian financial systems. So financial market, let's talk about financial market first. What is market? Market is a place where a certain product can be traded. Same goes to financial market, because we have lots of types of financial securities, financial instruments. So we have a different segmentation of financial market. So for example, money market instruments, so it will be traded in money market. Equity, it will be traded in capital market, for example, like that. So financial market are market which funds are moved from one people who have access of available funds to a people who have investment opportunities. So they have a direct effect on personal wealth and behavior of the business and consumers. So therefore, they contribute to increase their production and efficiency in overall economy. Financial markets such as bond and stock are market securities that are being traded. Okay, mostly as an individual, the most famous securities that are being traded are bond and stocks. They are also derivatives. They are also T-bills, but only a certain people who involved with this kind of trading. All right, so Malaysia financial market is governed and regulated by Bursa Malaysia and also Malaysia Stock Exchange. So Malaysia Stock Exchange is for share trading. So earlier it is known as Kuala Lumpur Stock Exchange, and this MYX is the barometer of Malaysian financial market. Okay, so before this it is KLSE, and then now now it is known as Bursa Malaysia. No, it's until now it is still KLSE, Malaysian Stock Exchange. All right, so securities. So securities are the financial instruments that are being traded in financial market. These are these different type of securities. It will be traded in different market. Okay, so they represent financial liabilities for the individuals or firm that sell them. Okay, those companies who sell the securities, they will earn money, they will get money. So who give them money? The investors who buy the securities. So that's why it become their liabilities, because at the end of the day, they have to pay back the money that they receive. Okay. So the borrower issue of the financial claim in return for money, the financial asset for the buyer, the lender, or the investors in the financial claim. So this is what as I said earlier lah. For example, me myself, I sell bond to public. So there are people who buy the bond. So when they buy the bond, then I got money. But this money I need to pay back to them in return. So whenever there are investors coming in, I owe them money, because they put their money in my business is because they believe that my business is profitable and able to give and able to pay back their money. So that's why it become my liabilities. So government and corporations will raise funds to finance their activity by issuing that instrument. All right, for example, like bond and equity instrument. Equity instrument example like shares. Okay, so bond are security that promise to make a periodic payment of a sum of a money for a specific period of time. Stocks are the securities that represent a share of ownership in the firm. Okay, so these are the example of securities. All right. So we know the securities, we know financial market. So financial market, financial securities, different types of financial securities will be traded in their financial market. All right, for example, capital, the financial instrument is the capital. The financial instrument is stock and bond. So stock and bond will be traded in capital market. So they are also money market instrument, for example, T-bills ataupun commercial paper. So this kind of securities will be traded in money market. Money market is a trading of securities which less than 1 year. It is the financial obligations will be lesser than 1 year. So there are also foreign exchange market. Foreign exchange market, they will trade the different type of currency. Okay, so they create the speculations on the price of the demand and the demand and supply of the currency. So it is available in foreign exchange market. It's also known as forex. There are also derivative markets. So derivative market, the derivative instrument can be traded in derivative market. So different segment of financial market will trade the different types of financial instruments. So it depends on what instrument that you want to trade. If you want to trade shares, then you go to capital market. If you want to trade currency, then you go to forex. If you want to trade commercial paper, then you go to money market. So different types of market. All right, so now talking about this market, where all this market available, how can we enter into that market? So this market, you can walk into financial intermediaries. So now what is financial intermediaries? Financial intermediaries is a place or institutions that allow all the financial market to be transacted. All right, so financial intermediaries also is a financial institutions that allow all the financial transaction can be done. All right, so financial intermediaries are the economic agents who specialize in activities. All right, specialize in activities of buying and selling. All right, so at the same time, the financial contracts, for example, loans, deposits, all the saving accounts, on all those debts. So these are the financial intermediaries. So note that the financial securities are not easily marketable, while the financial contracts cannot be easily sold or to be marketed. So banks is the form of the largest financial institutions in our economy. So they accept deposits, loans by the individuals or firms to bank and make loans. All right, so this statement actually, it means that banks is the largest financial institutions. The financial institutions, it's not only bank. Okay, bank, as you know, is the commercial banks. For example, like AFI, Maybank, CIMB, all those banks are commercial banks. They are also non-bank, but they give services or they give financial services. So we call them as financial intermediaries or financial institutions. So these financial intermediaries, other than bank, example like insurance and takaful, they are investment banks, they are EPF, they are SOCSO, they are koperasi. What else? EPF, SOCSO, all those all those institutions are considered as financial intermediaries because they give financial services, right? But above all people know, a layman people, what they know about financial intermediaries, they will know that it is bank. So financial intermediaries, not only bank, they are also all the institutions which give financial services, right? So that's all.